We have a good number. I'm sure a few more will trickle in here soon, but happy to get going. So thank you for joining us today for the AV Seed Fund webinar, 10 predictions for seed investors in 2024. We're not clairvoyant or anything, but we do see some trends, and we'll do our best to let you in on what we're seeing that may be of interest for seed investors. Before we begin, just a few quick housekeeping items. You will be on mute and off camera for the entire presentation. There are links in the side panel for those who would like to read ahead or schedule a call with our team. You can submit questions in the chat in the GoToWebinar panel. Those will be passed along to us. Several people have already submitted some questions in advance. You're also welcome to email, if that's easier, investor.relations@av.vc if you'd like to get us some questions while this is in progress. We'll be following up with everyone who submits questions afterwards, after the presentation as well, and we'll be sharing a recording with everyone via email. I think that's it. Let's see, disclosures here. I have to remind everyone we're speaking about Alumni Ventures and our views on the investing landscape. The presentation is for informational purposes only and is not an offer to buy or sell securities, which are only made pursuant to the formal offering documents for the fund. Please review important disclosures in the materials provided for the meeting. With that out of the way, we can do some quick introductions. So my name is Ron Levin, managing partner here at Alumni Ventures. I've been with AV for close to 5 years, actually. Was previously working on our Yard Ventures fund for the Harvard alumni community before transitioning over to the Seed Fund last year. I was actually previously introduced to Alumni Ventures as an investor myself, so I've been an investor personally with AV going back quite a few years now, and have remained a very active investor. And I've been able to sort of channel my interest in entrepreneurship into the investing side. Prior to becoming an investor, I was co-founder and CEO of an enterprise travel platform based in Barcelona called TravelPerk, which I was the founding CEO, left fairly early, but has since gone on to great things, becoming a large organization with a unicorn title now. I've spent most of my career at the intersection of travel and technology, and was an entrepreneur from age 11. So very interested in startups and innovation. And that's why I love what I do. I get a chance to meet great entrepreneurs every day who have exciting ideas. And it's a privilege to be able to filter through those ideas and invest in many of them, and also participate in the journeys of some quite remarkable founders. I'm also now proud to say I'm a published author, so have recently published a book called Higher Purpose Venture Capital, which profiles venture-backed companies that are solving problems related to both the causes and symptoms of social and wealth inequality. A way for me to channel my interest in using the power of being a VC to help solve large societal problems at a massive scale. So we are basically, as a seed fund, investing across many different sectors. We're going to talk about that briefly as I get into the agenda for today's webinar. But first, I'll hand it over to my colleague Mira to introduce herself.
Awesome, thanks Ron, and it's great to be here with all of you. My name is Mira Oak. I'm a senior principal on the Seed team. Prior to jumping into venture, I worked at Yale for quite a while on their endowment finance team, and also built enterprise product at the university, launching their first ERP, switching from Oracle to Workday. So saw that B2B SaaS wave live and actively participated in it. And with that sort of perspective, I couldn't help but jump into the tech wave myself. I joined a venture studio based in New York and helped launch their first business, and several others after that. and then later joined Alumni Ventures. And now I'm coming up on about 3.5 years with the fund, and have really enjoyed focusing my time on the pre-seed and seed stages, and I've really enjoyed working with Ron. So glad to be here today.
Great. So we'll hit a few points. We want to make sure for those of you who've perhaps not invested with us in the past or would like a little refamiliarization, we'll discuss a little bit about why venture capital as an investment vehicle, how we create our portfolios, what the Alumni Ventures Seed Fund specifically does, and then hopefully we'll spend the bulk of our time talking about some of our predictions. Mira and I will each take a bunch of our 10 predictions for seed investors in 2024, and then we'll wrap up with some logistical details and get to some Q&A at the end from questions that have been submitted. So basically, the Alumni Ventures Seed Fund is a well-diversified venture portfolio. We are crafting a portfolio over the course of this year of 50 to 75 companies that will be at the pre-seed to pre-series A range. Basically, we get in early enough that their valuations are still very attractive, that present significant upside potential. Now, we don't get in so early that it's typically just an idea of one or two people written on a napkin. Usually there's more to it than that. Very often there's an initial product, sometimes called an MVP or a minimally viable product that's been built. Sometimes they're early customers. Sometimes there's even some real progress and traction to report, including revenue and so forth. It can vary a little bit, but that's all kind of in the bucket of seed, which is sort of the predecessor to what we classify as early stage and then growth stage investing, which would be Series A, B, C, and beyond, all leading up to an eventual sale or IPO. Venture capital is an attractive asset class over many different time periods. If you look over 5, 10, 15, 30 years, it's an asset class that has outperformed public equities. If you put your money in the S&P 500 versus a well-diversified venture capital portfolio, you would have gotten significantly larger returns from the venture capital portfolio. Now, nothing comes for free, so there is certainly risk. Any individual portfolio may underperform, of course, and as you can perfectly appreciate, because these are early stage investments, they are not as liquid as being able to sell a stock or mutual fund on a moment's notice. But rather, these are investments that are long-term. They can take 3, 5, 10, or sometimes even more years before the company is sold or goes public or there's an opportunity to redeem. So because of that lack of liquidity and the risk entailed, that is compensated for by higher returns. And that's why if we're doing our jobs properly as venture capitalists, we should be exceeding the public equity markets. So this is not something you would want to put all of your pennies into, but if there's a portion of your portfolio that may go into a longer term investment category, venture capital can be an attractive alternative investment vehicle. We've seen obviously very fluctuating markets the last 2 years in particular, definitely some degradation in market conditions, which has provided a reset, and that's part of what we'll be talking about today. Where do we go from here? But in general, over longer periods of time, this has been an asset class that has both outperformed and not necessarily correlated with public markets. So we feel it's a nice addition as part of a well-diversified investment portfolio. So over 10,000 people have already invested with Alumni Ventures across our many different funds. Here's a little bit of the benchmark returns that I had mentioned. Alumni Ventures is currently the most active VC firm in the United States and number 3 globally. That was for 2022. We expect the data will come out soon for 2023, and we may very well be right up there at number 1 again. Since 2014, our inception, we have raised over $1.25 billion, and we've deployed that into over 1,300 portfolio companies. well diversified across sectors, stages, and geographies. We have over 40 full-time investors on our team that's spread across 6 different offices around the country, from East to West Coast. I myself am in Boston, Mira's in Silicon Valley. We also have 90 support professionals backing us up across investor relations, communications, fund accounting, legal, and other functions required to operate a professional venture capital firm. We do operate professionally managed venture portfolios. So if you invest with us, you do get access to essentially any individual fund will have at least 20 to 30 investments within them. Our seed fund, as we'll get into, actually has a larger portfolio, and we'll talk about that and some of the reasons why we have a larger portfolio on the seed side, because there are strategic reasons for that. But there are over 40 different funds within the Alumni Ventures umbrella that are open to investors at any point in the given year. We have over 600,000 people who are opted into our communities, who receive our emails, newsletters. We consider ourselves a network-powered venture capital firm, so bringing together the power of a giant community of largely highly educated professionals who are interested in startups and ventures. So even if you're not ready to invest with us just yet, we welcome you to be part of our community, to follow us, to attend these types of webinars. You may join our expert network, where we might connect you with one of our portfolio founders that's seeking expertise that's related to your own areas of interest and knowledge. A lot of different ways to get involved in addition to becoming an investor with us. One thing I wanted to mention up front, Mira will go into the seed fund a little bit more specifically in a moment, but one of the things that makes us unique and differentiated, and something that's, as far as we know, not done by any other professional VC firm, we have a super angel partner program where we work with experienced, active angel investors to tap into early stage or seed stage deal flow. This has been fantastic for us because we're able to selectively connect and partner with very distinguished angel investors who are themselves sourcing and vetting deals within their own areas of knowledge and expertise. And that has led us to quite a few opportunities. Even in the last year, we made about 35 investments that were referred to us by our angel partners, including deals led by some of the top name venture capital firms like Sequoia, Excel, Matrix Partners, and others. And they've been global and across many different sectors. We do cover virtually anything that's tech related or tech driven, largely because these are the most scalable business models. And our network of super angels have helped us to do that. On the next slide, we'll just show just a few quick profiles. This is a representative sample. This is not all of our super angels, but they come from all different industries. Some of them are professional investors, some are entrepreneurs. Many have experience in very deep in specific sectors and geographies. But just to give you an example of the diverse backgrounds of angels we work with, this is really what we feel one of the strongest competitive advantages that we have in truly using the power of our network. And if that sort of profile applies to any of you individually, you're certainly most welcome to reach out to us. We're happy to bring on new angel investors as well and talk a little bit more about the way we work together. So with that, I think I will turn it over to Mira to talk a little bit more about the seed fund before we jump into our predictions.
Awesome, thanks, Ron. Yeah, just let's run through a quick punch list of what actually makes up the seed fund here. So Ron and myself, we will pull together a portfolio of 50 to 75 deals over a year and a half time horizon. We ensure that it's a diversified portfolio, both by sector and geography, and as well as sort of exceptional lead investors that we follow. We actively manage, our follow-on opportunities because as many on this call know, it ensures that we're chasing our winners. And this is all achievable with a $25K minimum investment from our investors. And this check not only gives you access to the portfolio, but it gives you access to our syndication offerings, which I'll go into a little bit later. Great. And so within, Ron alluded to this earlier, within a seed portfolio of 50 to 75 deals, we bring you diversification, both by sector, which you'll see on your left, and by geography on your right. Many of our investors choose to reinvest in each fund vintage because this type of diversification really helps minimize risk and maximize opportunities for return. This is also something that we're able to achieve through our geographic reach. Not only I'm based in, as Ron mentioned, in the San Francisco area, he's based in Boston, and our super angels really exist everywhere. And so as experts in their own fields, and as with Ron and I's sort of geographic presence, we're able to surface really promising opportunities across the board for investment. Great. And through our personal networks and the Alumni Ventures community, it really enables us to invest alongside some of the best names in venture, as Ron already mentioned, with Sequoia and Excel and others. And this is really core to our strategy here. Not only are we looking for a lead venture fund that has a track record of success, we're also looking at the components and members of that team in particular, and the lead partner. Their background and prior investments are really sort of critical to ensure that they're offering the best counsel to a portfolio company, and it ensures that we're really fine-tuning our approach and making sure that the best person is the best positioned to add value to the portfolio company. And so we really incorporate that into our diligence process. And finally, just to ensure that we're bringing a highly vetted portfolio to you, we bring each company through a 3-step scoring process to evaluate each deal through an objective lens, both within the fund investment team, with the fund's investment committee, and then with the broader AV investment committee. And this is my favorite part, is always sort of highlighting the founders and the companies in our portfolio. We wanted to give you all a teaser of some of the portfolio companies that have been included in the seed fund in the past. And candidly, there's always too many to choose from, but I'll go ahead and highlight one to illustrate just a bit of the breadth that we cover. So we invested in a company called Inspira Education, which is a managed marketplace for higher education services, helping parents and students connect with leading education counselors around the world. And most recently, they incorporated AI capabilities into their product to streamline both the matching process between counselors and students, but also the ideation process with students. So when they're brainstorming, how to craft the right essay that will resonate with the appropriate higher education institution, AI has been really critical to their growth. And this company has grown considerably, since we invested in their seed round alongside Craft Ventures and lead partner Jeff Fleur, who was the former CEO of StubHub. And so we were really thrilled to see them hit their unannounced Series A this year, and excited to sort of follow that journey even more closely. And as I mentioned earlier, beyond a diversified portfolio, we also give our investors the opportunity to invest in a single company or a small group of companies to really personalize their portfolio. And all companies are brought through that same process that I mentioned earlier, but this syndication sort of outlet gives our investors the opportunity to really lean into investments that truly resonate with them. And as an example, we have Rawazi, which is in our Seed Fund 5 portfolio, but it was also offered as a syndication opportunity. And it's a company that aggregates consumer data in Africa and Asia and sells it to Fortune 500 brands based in the US and Europe. And this is a really powerful insight for Fortune 500 brands, because Africa and Asia represent significant market opportunities. But for any brand, it's often challenging to determine, what the entry point should be, which products they should push, what the price should be. And Rawazi, essentially gives these brands a leg up. They're bringing pretty robust data that helps inform their go-to-market strategy. And not only has this company scaled 2x since our investment, they've also been honored with prestigious awards from the city of Los Angeles, Forbes, Techstars, at the African Leadership Network. So this company's been firing on all cylinders over the past year, and I'm so excited to watch and support that story as well. And now I think it's time for our crystal ball portion of the chat. So I will hand it to Ron to gaze into the future.
Yeah, put on my Nostradamus hat here. No, as I said in the beginning, I mean, this isn't so much about trying to be pie in the sky and who knows what might happen. This is really informed by some of the trends that we're seeing and kind of a little bit of the state of the market and some of the indicators that we're looking at. So I hope this will be informative. This isn't meant to create any headlines or say anything drastically absurd for the sake of getting some attention. This is really just about our feeling of where things seem to be heading at the moment. So Mira, feel free to jump in if there's anything you'd like to add to any of these. But the last couple of years, it's been kind of an adventure in the market over a number of years, and we've seen quite an up until COVID, things were really buzzing for a while, and then we had this sudden shock, of course, but then quite remarkably, this very quick recovery that I think because there was so much government stimulus going into the market that may have even overcompensated for losses and was kind of a whole across the board thing. The economy came very strong out of COVID and continued so for some time until it didn't, because all things go in cycles and inflation started rearing its head and Fed had to act with interest rates and that one thing led to another. We had the Silicon Valley Bank collapse. A lot of things happened over the course of 2022 and 2023. So the frothy days kind of came to an end, and it was a gut check. And these things are both necessary and expected with these markets. Not everything is a straight line up. It's never that easy in life. So we've hit a rough patch. And what that's effectively mean, it doesn't mean there aren't fewer entrepreneurs with great ideas, but it does mean that there's less capital and valuations came down as a result. As investors were holding on to cash to see what would happen, what we call in the industry dry powder, kind of holding on to cash for their investors until some promising signs emerging. There are promising signs now. In fact, we're a little bit behind the public markets. Obviously, if you're watching the stock market hitting all-time highs again, you might be wondering, well, what about venture markets? Like, it doesn't seem like there's many companies going public, there's as much M&A going on, and that's true, there hasn't been. There has been a bit of a disconnect. I think because of the odd confluence of events in the markets the last couple of years, between inflation but low unemployment and all of these different factors kind of playing into it. I think the markets didn't always know how to react, and I think the higher risk investors, which includes those of us on the venture side, sort of had to take stock of it and figure out where are we really headed here. But it seems like we've hit some kind of a soft landing. Inflation has cooled. The employment market remains robust. The Dow is at new highs again. We've kind of avoided recession. All of this good stuff essentially should provide some confidence to the market that we were not heading toward a chasm somewhere, that things are actually going to be okay. So for seed investors, we do see significant signs of recovery, and this is not just playing out in terms of valuations. We're seeing more investor appetite at early seed stage rounds. A lot of term sheets from good VCs that we're seeing some uptick. Other folks that we talk to who have a strong pulse on the market, such as some of the lawyers that we work with on these transactions, who tend to see things as they're happening a few months out, have commented about signs of increased levels of activity toward IPO and M&A, which hopefully will lead us back to recovery. I think it's also interesting to note that before the market recovers too much, as any good angel investor or I'm sorry, value investor will tell you, you want to get in when the markets are down. And I particularly like one quote. There's a prominent late angel value investor by the name of Shelby Cullum Davis, who once said, "You make most of your money in a bear market, you just don't realize it at the time." So it takes a little intestinal fortitude to invest when markets seem down, but that's when the opportunities are ripe. And we think we're kind of at a critical point there before things start to get on a really strong uptick to get in while valuations are attractive.
Yeah, I just add, Ron, I think that's a great commentary on sort of investor appetite. I think what I've observed also in founders is that there's just been a refocus on back to the basics, right? Like I think founders are more cognizant of capital efficiency. They're building businesses that have strong unit economics, ones that are really well positioned, that they're optimizing for profitability, right? It's not a growth at all costs sort of game as much anymore. And so I think to your point, just the timing for investment is really investing in companies now that are sort of positioning themselves in a stronger way for that growth ahead. So yeah, I completely agree.
Absolutely. So that kind of leads into the second one. With some shakiness still in the markets, what sectors are going to be more in favor or less in favor? There's a lot of geopolitical risk at the moment. I'm sure I don't need to explain to anyone about the wars, about pending elections, all the other things coming in the pipeline. I see there are other countries, of course, around the world that are facing recession and more difficult macroeconomic circumstances than in the US. So still a lot of instability. We think that there are certain markets that are going to continue to fluctuate. The energy markets, cryptocurrencies are always, in flux. But there are very stable markets as well that are a little bit less cyclical, where there is true strength. I think we're going to talk a little bit later. Mira will cover one of our predictions related to education, which is one of those markets, as well as another related to health technology, which tends to be stable in all climates. We also see a lot of interest right now in security and defense technology. So those stable markets that are a little bit less cyclical, we feel are going to be, a stronger bet for the year ahead. Excuse me. So we do think that the IPO and exit market will start showing some signs of life here. Last year's IPO market was a bit strange, not very much activity. There were a few notable IPOs here and there, ranging from prominent Boston software company called Klaviyo to the restaurant chain Kava. Reasonable success, not necessarily performing super well, sort of post-IPO across the board, but it's a mixed bag, as one would expect. But as I mentioned, our predictive indicators are showing that there's more discussions happening, and moreover, investors starting to seek returns, because investors like us do not have an infinite window. We have a long-term horizon, but it's not infinite. Generally, the horizon's about 10 years. It can vary a little bit by fund, but the investors that hold the shares in private companies, whether it be venture capital, private equity, buyout, or other strategic investors, family offices, and so forth, do need to see liquidity at some point, and only have so much patience. And there are companies that are waiting in the wings that are essentially ready to go public. They have enough revenue and profitability. They've just been waiting for the markets to be stronger. We think that the public markets are a leading example that there is enough fuel in the fire that it's probably a smart time for a lot of companies that are ready to go public or be sold to think about doing so. Angel investment activity, we do think will also emerge. Angel investment activity has not declined terribly significantly through the trough of the last couple of years. However, it's very much the retail investors, folks potentially like yourselves, who put money into the earliest stages, the friends and family rounds, what we call pre-seed, very early stage idea and basic product and maybe no revenue yet. But they need to get liquidity back as well. So it's very important when the IPO markets, the public equity markets sort of start carrying more ventures to liquidity, that will provide more capital for these retail investors to deploy into some of the earliest stage companies. So it's kind of a cycle, but we do see that an acceleration is likely to occur, particularly toward the second half of the year, and this should hopefully lead toward stronger deal selection as well because of the shakeout of the last couple of years. Some of the more tenuous business models have kind of shaken out, and I think it's a good call to reality as investors learn about which companies are more stable, companies that are able to generate revenue faster and control their burn rates better, which is very important for the earliest stages of investment. So we do think that this increase in angel investment will help stimulate the market for seed funds like ourselves. On the other end, we'll go to the next one, growth funds. These are the funds that typically invest later, Series C, Series D, pre-IPO. Folks like SoftBank, like Tiger, like some of the hedge funds that are also involved in venture investing, where they come in and maybe write a big check, 20, 50, $100 million. They are starting to emerge. We're starting to see signs of activity. This is where there was really a lot of that dry powder accumulated over the last couple of years as the IPO market became very quiet. So there's a lot of capital on the sidelines. The LPs of these funds are looking for that capital to be deployed, and we're starting to see some initial signs of large funding rounds taking place, which will spur companies to likely exit within the next couple of years, post these rounds of investments. So we think this is a hopeful sign and a realization that we can't wait forever. There's a lot of capital and there's great founders who need that capital to grow. And so now is a good time to deploy. So I think Mira, I'll let you take the next batch.
Yes, and off for the least surprising prediction probably on this list for all of our listeners. It's hardly a stretch to sort of argue the impact of AI, and it's really just getting started here. I think for years we've seen sort of this emergence of vertical SaaS or sort of cloud-based software that's sort of tailor-made for specific industries, and they've increased their presence as part of a broader trend of end users really demanding customized products. And with this AI platform shift sort of upon us, we're seeing that next logical iteration of vertical SaaS, which is now taking the form of vertical AI. And so vertically focused AI platforms are sort of bundled alongside workflow SaaS, and it's built on top of models that are uniquely trained on sort of industry specific data sets. So call it fintech or healthcare, as Ron mentioned. And, we've already seen this, in legal and, as I mentioned, healthcare. And I think we expect to see this, in many more legacy type industries. Anecdotally, I think there's a lot of industries out there that, are even now still adopting software, like transitioning from pen and paper to sort of software or cloud-based, software platforms. But I think AI is almost in many ways catapulting that initial intermediary step. And so it's really exciting to see some of these industries, take the leap with AI and sort of almost be level set with some of their peers in other industries.
And I would just add to that, I mean, we saw probably about a year ago or a little more, AI kind of becoming a household word. I mean, AI is not new, it's been developing over many years, but it kind of became household words so that anyone's grandmother suddenly knows what AI is. I think largely because of the large language models, the LLMs like ChatGPT, where anyone can kind of sit down in their computer and suddenly start using AI and see the power of it. But we're investing in companies that are using AI in so many different ways that really are across industries. That from drug discovery to going through how, assessing 1 million compounds at once to see what might, find a cure for a particular type of cancer, to using AI in quality inspection for heavy manufacturing, which is one company that we invested in recently, to creating an AI twin, meaning creating your own kind of personal avatar who looks and talks the way you do, because you've given them enough inputs that you can create a virtual version of yourself through AI. And there's just such a wide range of applications that the power is almost limitless, which can be scary in a way, but hopefully we'll at least be supporting the companies that are trying to use this in a positive way, and we'll be thinking about that as we approach these investments.
Yeah, absolutely. Awesome. So yes, I think, as Ron alluded to, with capital sort of relatively scarce, I think particularly at that early growth sort of stage at the Series A and Series B, we're anticipating that more companies will seek out leverage both within and beyond their space. And what I mean by that is, from a market perspective, companies either employ a direct sales motion or a partnerships motion or some combination of both. And I think this past year and likely into this year with capital efficiency really top of mind, I think we expect that companies might actively seek out partnerships to gain this economies of scale across marketing and sales. I mean, if you think about sort of, traditional sort of costs, customer acquisition costs, it can be quite expensive, in the consumer lens to reach your end customer. And so I think we're finding that companies are more open to collaborating to sort of mitigate that cost and sort of reach a shared sort of customer base alongside some of their sort of compatriots in their field. And so there's been I've seen more of an active push for the partnerships motion than sort of purely direct sales from companies.
There's a lot of economies of scale to be had when there are multiple competitors kind of in the same sandbox, and kind of a market shakeout is good to, in some ways, to say, okay, well, what are really your strengths? Are you great at sales? Do you have the best product? Maybe we can get together with someone that complements our strengths. So indeed, I think this we'll see a lot more of even smaller venture-backed companies kind of getting together over the coming year.
Yeah, and I think that we've seen it in fintech with banks sort of partnering with early stage fintech companies. So I think, yeah, that's almost a playbook that is likely to repeat itself in a lot of different industries. Awesome. Yes, higher education. I know Ron sort of mentioned this earlier on, and online learning has been around for quite some time. In fact, I was at Yale when they first introduced MOOCs, which at the time felt like revolutionary, and now it's sort of par for the course here. It seems as though we're headed for a resurgence of new modalities that are challenging the traditional higher education experience. This is likely a byproduct of a few different drivers. I mean, tuition costs have been growing at 4 to 5% every year. There's been a push from employers for really direct skills rather than degrees. And even Ron and I have seen sort of several companies taking aim to disrupt the structure by giving K through 12 students and higher ed students, access to training programs and content that have a direct tie to an end profession like product management or marketing, fields that don't necessarily directly correlate with a major. So it's kind of an interesting sort of disconnect that I think startups are like capitalizing on and leaning into. So I think we expect to see a great deal more of this on the horizon.
Yeah, the affordability and accessibility are key. Not everyone can afford. I mean, there are colleges that are charging upwards of $70,000 a year all in now, which is mind-blowing. I mean, the amount of student debt most people have to take on to get a liberal arts education, when maybe you can get the skills you need from online learning, and if you want to supplement with community college as needed for liberal arts education, that we think is going to be more accepted in society by employers. I think the low unemployment that we've had over the last few years has helped trigger that. A lot of, in fact, professions that used to require a college education no longer do so. I mean, many leading tech companies no longer require a bachelor's degree. Even to be an airline pilot now, it was always a requirement to be a college graduate, and now they're saying, well, if you can test and prove that you have the skills, maybe that's just an arbitrary requirement that's not actually needed. So I think, you know, finally this prediction from the dawn of the internet age that online education would be everything, we think it's starting to come true, and we'll be living up to that in the years ahead.
Absolutely. Great, yeah, and you know, I feels like, you know, the pandemic was just yesterday in some regards, but I think as a result of the pandemic, you know, telehealth went from this underutilized sort of option to a necessary part or a necessary way to receive care seemingly overnight. And I think consumers have become more and more comfortable with this medium of care. And I think we expect to see even more demand for these services, both within and beyond what the employer is sort of able to offer. And I think, you know, digital health has, you know, it's so top of mind for folks. You know, it's become a key lever of employee retention when it comes to workplace benefits, because it ultimately drives happiness and wellness. And so I think this is going to come to the forefront for folks as we move into 2024. And last but not least, you know, I feel like, you know, on our team especially, we've been talking a lot about sort of longevity and the quality of aging, and I think it's just really grown to the forefront of sort of investor minds. You know, as a result, you know, food, diet, wellness, technology are all top of mind here. You know, and this past year, we've seen great interest in GLP-1 drugs as people make sort of more concerted efforts to lose weight, to manage chronic conditions, and control their health in sort of rapidly new ways. We are really expecting a more dramatic effect on eating habits and thus the food supply chain. We're also expecting, you know, that this utilization of connected devices will grow as people monitor their health in ways that were simply unavailable, you know, a few years ago. So I'm really excited to watch and support this category.
Great. Our senior partners are here to help. If you're interested in investing, feel free to reach out. Dan, Stacy, and Darren lead on that. Go to the next slide. So running up a little bit against time, but maybe we can do a few questions. We'll try to do them fairly quickly.